So I want you to picture this. It is today, April 16th, 2026, and you are staring at a stock chart. Prologis Inc., ticker symbol PLD, has just, punched through the ceiling to hit a brand new 52-week high of $144.05.
Yeah, and you look at the technical indicators, and they are practically screaming strong buy at you.
Yeah.
In bright neon green.
Right. But then you open up another tab, you look at some discounted cash flow valuation models, and they are flashing this bright red warning sign. They're suggesting this exact same stock might actually be 28% overvalued.
There's a massive discrepancy.
It is. So which is it? Is Prologis a breakout star that you absolutely need to be watching right now? Or is it like a falling trend in disguise, just waiting to trap retail traders who are showing up late to the party?
Well, it is the ultimate market paradox. I mean, you have raw price action and momentum telling you one story that the market absolutely loves this stock right now.
Yeah.
And then fundamental intrinsic value models are telling you the exact opposite. When those two forces collide, it creates a massive amount of noise, and usually a significant amount of volatility is right around the corner.
And cutting through that noise is our mission today. Since we built this custom deep dive just for you, we were going to look under the hood of Prologis.
Exactly.
We're unpacking the hard data you shared with us. So the financials, the insider trades, and those technical signals, all to figure out what is really driving this machine.
It's going to be a fun one to dig into.
Oh, definitely. And because this deep dive is tailored for you, make sure you drop your mandatory feedback in the comments. Let us know if we hit the mark, like the video, subscribe to the YouTube channel. You know the drill.
But we should also lay down the baseline right up front. We are analyzing the mechanics of the market data you provided. We're looking at how these metrics interact.
Right.
This is absolutely not financial advice, and you should always do your own research before making portfolio moves.
Okay, let's unpack this. Before we can even begin to debate whether this 52-week high is a value trap or, a treasure, we have to look at the foundational numbers.
Underlying data.
Exactly. Why did Prologis reach a peak of $145.01 in the first place? Looking at the stats, the current stock price as of midday today is $144.05.
And over the last 52 weeks, it has ranged from a low of $97.10 all the way up to that $145.01 high.
That is a wild swing, and we are looking at a massive market cap here of $134.22 billion.
That's a behemoth.
Truly. And the immediate catalyst for this recent surge was their Q1 2026 earnings beat.
Yeah, the magnitude of that beat is what really caught Wall Street's attention. Looking at the quarter that just ended on March 31st, their net earnings jumped to $1.05 per diluted share.
Oh, wow.
Right? A year ago, in Q1 2025, that number was just 63 cents. So you're looking at substantial year-over-year growth there.
That's almost double.
Yeah, and their trailing 12-month revenue is sitting at roughly $8.79 billion. But as we know, for a real estate investment trust, or a REIT, standard net income is heavily skewed by non-cash deductions.
Right. Yeah. Looking at standard net income for a REIT is pretty much useless because of paper depreciation.
Exactly.
The IRS lets real estate companies deduct the declining value of their physical buildings from their taxes, which, artificially lowers their net income on paper.
It makes it look worse than it is.
Yeah. So that's why I was looking specifically at their Core FFO, or funds from operations. It hit $1.50 per share, up from $1.42 a year ago.
And that's the metric that matters.
It really is. Think of it like this Core FFO adds back all that paper depreciation. It's like a landlord's actual cash in hand from rent rather than just the paper value of the building. It's the actual physical cash the landlord is putting in their pocket minus the bills they had to pay.
Yeah, it's the pure cash generating power of the business.
Yeah.
FFO is the absolute lifeblood of a REIT.
Right.
Beating analyst estimates on Core FFO is a primary trigger for institutional investors to start accumulating shares. They're looking at the cash, not the tax deduction.
Makes sense.
Furthermore, when you look at how they manage that cash, their balance sheet is functioning like a fortress. They currently have total liquidity of about $6.7 billion.
See, my immediate worry with any commercial real estate entity right now is the debt.
Oh, absolutely.
We are in an environment where interest rates have fundamentally changed the math for landlords. The refinancing cliff is a massive boogeyman for the broader sector.
It's taken a lot of companies down.
Yeah. But looking at their ledger, their debt to adjusted EBITDA ratio is sitting at 4.8x.
And that 4.8x ratio is incredibly healthy for a REIT of this scale. To put in perspective, debt only makes up 23.8% of their total market cap.
That's surprisingly low.
It is. A lot of commercial real estate companies operate with significantly higher leverage. They're relying on constant refinancing to stay afloat.
Which is a dangerous game right now.
Very dangerous. But Prologis isn't playing that game. Their operating cash flow for 2025 was incredibly steady at $5.01 billion. That represents a 2% growth.
So they're stable.
Very stable. They have insulated themselves from the worst of the interest rate squeeze, which gives them the dry powder to weather broader economic storms or, aggressively fund new expansions.
Okay, so they have a fortress balance sheet, billions in liquidity, and they are generating more physical cash than they were a year ago.
Yep.
If the company is genuinely doing this well, the people running it should be doubling down and holding every share they can.
Right.
You would think so. But when we look at the actual order flow and the insider trading data, they aren't. And that creates a massive divergence between what the paper says and what human beings are actually doing with their own money.
Yeah, the order flow data paints a highly complex psychological picture here. Let's break down the broader market sentiment first, looking at short interest.
Okay.
It is remarkably low, sitting at just 1.3% of the available float. In the most recent reporting period, that short interest actually decreased by another 2.2%.
Which means the people betting against the stock are actively packing up and going home. But what's interesting about short covering is the mechanical effect it has on the stock price. Like, when a short seller wants to close their position, they have to go into the open market and buy the stock back.
They're forced buyers.
Right. So not only are the bears giving up, their exit strategy forces them to become buyers, adding even more fuel to the bullish momentum.
And that creates a baseline of upward pressure.
Mm.
The broader market sentiment is undeniably leaning positive.
Right.
But then you look at the executive suite. The insider activity data shows a predominantly selling environment.
And this is what I can't wrap my head around. Wait, if the Q1 earnings were such a massive beat and the short sellers are literally being forced to buy the stock to cover their exits, why is the CEO cashing out?
It looks bad on the surface, I know.
It does. The sources show that CEO Daniel Letter sold roughly $2.11 million worth of shares at $132.18 on March 31st. That was just days before it hit this new 52-week high of $145.
The timing is definitely interesting.
Why take $2 million off the table right as the company proves its cash flow is stronger than ever?
Well, what's fascinating here is that we have to separate the psychological impact from the mechanical reality of executive compensation.
What do you mean?
Insider selling is rarely the pure panic signal that retail investors assume it is. Executives at this level receive massive portions of their compensation in stock.
Oh, right.
They routinely sell to pay the tax obligations generated by those stock grants, to buy real estate, or simply to diversify their portfolios so their entire net worth isn't tied to a single ticker symbol.
So it's not always a red flag.
Exactly. It's often pre-scheduled months in advance.
Even if it's pre-scheduled, when retail traders see the CEO dropping $2 million worth of stock onto the market, it plants a very real seed of doubt.
Sure, yeah.
Especially when the stock is already trading near historical highs. But it wasn't all selling on the ledger. I saw another massive figure hit the type on the exact same day.
The director's acquisition.
Yeah. Director Hamid Moghaddam reported acquiring $130 million in shares.
Which sounds incredibly bullish until you look closely at the mechanics of that specific Form 4 SEC filing.
Okay, what did I miss?
Yes, the acquisition happened on March 31st. However, the sources note a crucial caveat regarding that $130 million figure.
Mm-hmm.
It is likely tied to administrative stock gifts, the vesting of restricted stock units, or option conversions.
Oh, I see.
It is highly unlikely that he wired $130 million of his personal cash to a broker to buy shares on the open market. It registers as an acquisition on the regulatory paperwork, but it doesn't represent the kind of aggressive, high-conviction insider buying that moves markets.
Okay. So the insiders are essentially a non-factor here.
Pretty much.
You have a CEO taking routine chips off the table and a director processing administrative stock conversions. If the people inside the building aren't giving us a clear directional signal, we have to look entirely at the raw price action.
Or the charts.
Exactly. We need to dissect the daily charts and the technical indicators to understand where the short-term momentum is actually heading.
Well, technically speaking, the institutional algorithms are reading this trend as strongly bullish. Prologis is trading well above its 50-day moving average, which currently sits at $135.89.
Okay.
And it is also light years ahead of its 200-day moving average, which is way down at $123.15.
And for the listener who might just look at the raw price, the relationship between those moving averages is critical. The 50-day is your short-term trend, and the 200-day is your long-term macroeconomic trend.
Exactly.
When a stock is trading above both, and the 50 days physically stacked above the 200-day, quantitative trading bots view that as a confirmed, undeniable uptrend.
They love that setup.
They really do. They are literally programmed to buy the dips in that specific formation.
And that algorithmic buying creates the floors and ceilings of the stock's price action. Right now, resistance to ceiling where selling pressure naturally kicks in is hovering right around that 52-week high of $145.
Right. It's struggling a bit there.
Yeah, it's struggling to break cleanly above that psychological barrier. On the downside, key support is established at the $136.94 pivot point.
Okay.
And there's an even stronger safety net at that 50-day moving average around $133.76. Across the board, the 5-day, 20-day, 50-day, and 200-day moving averages are universally outputting a strong buy signal based on price momentum.
But momentum isn't infinite, right? And this is where we have to look at the RSI, or Relative Strength Index.
The overheat gauge.
Yeah, think of the RSI. It's kind of like driving a sports car. The momentum and moving averages are the pedal to the metal. You're flying. The RSI is the engine temperature gauge flashing red, warning of an imminent overheat.
That is a perfect analogy.
Because right now, Prologis has an RSI sitting at a scorching 77.43.
Which is very high. The math behind the RSI measures the magnitude of recent gains against recent losses over a specific period, usually 14 days.
Right.
Anything over 70 indicates that the upward momentum has outpaced a sustainable trajectory.
Right.
So the stock is officially categorized as overbought.
Which means the engine is running dangerously hot. It doesn't mean the car is going to explode or that the bullish trend is entirely over, but the tension is immense.
Something has to give.
Exactly. The physical laws of the market dictate that the price either has to pull back down or trade completely sideways for a few weeks just to cool off that engine and let the moving averages catch up.
And the underlying momentum indicators are confirming that need for a pause. If we look at the MACD, or the moving average convergence divergence, it is starting to output mixed signals.
Oh, really?
Yeah, one provider even cited a negative 0.86 sell signal.
Wow.
The MACD measures the relationship between a fast exponential moving average and a slow one. When it flashes negative in an uptrend, it means the short-term momentum is actively losing steam and crossing below the longer-term trend line.
I see.
The stock is moving higher, but the energy pushing it higher is fading.
And that tension, the undeniable upward price action colliding with exhausted, overbought technical indicators, leads us directly into the biggest debate on Wall Street right now.
The valuation debate.
Exactly. Is Prologis genuinely undervalued based on its future potential? Or is it a massive value trap waiting to snare retail traders who are buying at the top of a completely overheated rally?
Well, the divergence in the valuation data is extreme. Let's look at the institutional consensus first. Wall Street analysts currently maintain a moderate buy rating.
Okay.
Out of the major analysts covering the stock, you have 13 buys, 7 holds, and absolutely 0 sells.
0 sells, but wait, look at the actual price targets attached to those ratings. The sources show that the average price target from these same analysts is clustered between $138.16 and $141.90.
Yep.
But the stock is currently trading at $144.05. How can Wall Street maintain 13 buy ratings on an asset that has already blown past the price they were targeting?
Well, if we connect this to the bigger picture, it tells us that the market has completely front-run the analysts' expectations.
Yeah.
The analysts are optimistic about the company's fundamentals, hence the buy ratings, but retail momentum and algorithmic trading have pushed the price beyond what the fundamental models originally justified.
They got a little ahead of themselves.
Exactly. Now, there is one outlier high estimate out there of $157. But the low estimate sits way down at $119. Historically, when a stock trades consistently above its average consensus target without a fresh catalyst, near-term upside is heavily capped.
And the valuation clash gets even crazier when you strip away the analyst opinions and just look at raw financial modeling.
The objective numbers.
Right. Simply WallSync claims $141.90 is the fair value, meaning the stock is priced almost to perfection right now.
Okay.
But then you look at discounted cash flow, or DCF models, from platforms like Alpha Spread and Value Investing. They claim the actual intrinsic value of Prologis is somewhere between $99 and $101.
Which is a huge drop.
Massive. That would mean the stock is currently 28% overvalued. So what does this all mean?
We have to understand how a discounted cash flow model arrives at that dramatic number. A DCF model is a highly strict mathematical way of valuing a business.
Okay.
It estimates all the future cash flows the company will generate over its lifetime and then discounts them back to what that money is worth today. It factors in inflation and the risk-free rate of return, like what you could get guaranteed from a U.S. Treasury bond.
So the DCF is essentially saying, based strictly on the physical cash Prologis is projected to generate from rent over the next decade. Paying $144 share today means you are paying a massive, unjustified premium.
Exactly. It completely strips away market hype, brand value, and AI narratives. It asks a simple question. Does the cash justify the price tag?
And right now, the math says no.
Right. It begs a critical question for the market. Are retail traders buying the intrinsic cash flow value of this real estate portfolio, or are they blindly buying the momentum of the chart?
To figure out how we bridge the gap between a $99 DCF model and a $144 stock price, we need to lay out the ultimate bull versus bear scenarios.
Let's do it.
Let's start with the optimist. What is the bull case for Prologis? How do they prove these strict valuation models wrong and continue this 52-week breakout?
The bull case is incredibly compelling, actually. And it requires looking beyond their traditional business model of leasing generic warehouse space to e-commerce companies.
Okay.
Yes, they have record leasing demand with 64 million square feet of traditional leases signed. But the catalyst, the structural shift that has institutional buyers ignoring those strict DCF models, is their massive expansion into high-growth data centers.
Oh, they are pivoting to become the physical infrastructure for the AI boom.
Precisely. Artificial intelligence requires massive data centers. Data centers require vast tracts of specialized real estate, intense zoning approvals, and unfathomable amounts of electrical power and specialized cooling infrastructure.
Which is hard to get.
Very hard.
Yeah.
But Prologis already owns the prime real estate. They currently have $1.3 billion into data center starts in the pipeline.
Wow.
They're transitioning from storing cardboard boxes for logistics companies to positioning themselves as the physical backbone of the global digital economy.
That is a massive pivot.
Add to that, their strategic joint ventures with heavyweights like GIC and La Caisse, all backed by that low 4.8x debt leverage we talked about earlier, and you have a company primed for a fundamentally new tier of growth.
That is a very strong narrative argument. If they pull off the transition to data centers, the future cash flows will absolutely eclipse historical models, which explains why the market is willing to pay a premium today.
Exactly.
But we have to be objective. Let's flip the coin. What is the bear case? Why might this 144 peak be a massive trap?
The bear case starts with how much of that premium is already priced in. Currently, Prologis is trading at a price-to-earnings, or PE ratio, of 39.2x.
Okay, let me guess. That's high.
Very. To give you context on how stretched that is, the industry average for their direct peers is just 17.3x.
Wait, so you are paying more than double the industry multiple for every single dollar of earnings they generate?
You are paying a tech company multiple for a real estate company.
Yikes.
Furthermore, if you look at their traditional warehouse business, there is a distinct lag in their rent growth compared to their occupancy recovery. They are keeping the buildings full, but their pricing power, the amount they can actually raise rents on tenants, isn't keeping pace with broader economic inflation.
And here's where it gets really interesting from a risk management perspective. I am looking at their payout ratio in the sources, and it is sitting at 120%.
Yeah, that's a red flag for a lot of people.
Now, I know we established earlier that REITs pay their dividends out of FFO, their physical cash flow, rather than their paper net income. So payout ratio over 100% isn't the immediate death sentence it would be for a regular tech stock.
Right.
But mathematically, hold on, they are paying out 120%. How is that sustainable, and isn't this exactly why retail traders get trapped? Chasing a dividend or momentum without looking at the payout math?
It's huge risk.
Because paying out 120% leaves absolutely zero margin for error, right?
Right.
What happens if these billion-dollar data centers run over budget?
That is the exact vulnerability the bears are pointing at. The dividend is safe today because the FFO covers it, but capital expenditures for data centers are astronomical.
Right.
If the macro environment shifts, like if interest rates spike again, making their low-leverage debt more expensive to eventually refinance, or if tenant demand drops in a recession, that 120% payout ratio becomes a crushing, inescapable weight.
Oh, wow.
They would be forced to cut the dividend to fund the data center pivot. And in the REIT sector, cutting a dividend is the fastest, most violent way to trigger a massive institutional sell-off. The stock would just crater.
So we are left with incredible tension here. On one side, you have a fortress balance sheet, $6.7 billion in liquidity, a massive pivot into AI data centers, and short sellers actively fleeing the scene.
The perfect bullish setup.
Right. But then on the other side, you have an overheated RSI engine, a MACD losing its short-term momentum, a PE multiple double the industry average, 120% payout ratio leaving zero room for error, and a strict valuation model screaming that it's 28% overvalued.
It's a lot to weigh.
It is. Let's synthesize what this means based on all the data.
Well, if we break it down by time frame, the structural reality of the market becomes a lot clearer. In the immediate short term, the data heavily suggests you should expect sideways consolidation or a minor pullback.
Makes sense.
The stock just hit a record high. It struggled to break $145, and that RSI of 77 means the technical engine desperately needs to cool off. Profit-taking at this level is entirely normal and, honestly, mathematically necessary.
But in the long term, the fundamentals driving that data center pipeline offer a very real, tangible growth story. If they execute on that $1.3 billion infrastructure investment, they could very well grow their cash flows to justify this current valuation multiple.
Absolutely.
But again, just to reiterate the baseline we said at the top, this deep dive is an analysis of the available data, the market mechanics, and the competing narratives. It is not financial advice.
We lay out the mechanics of the market, you decide how to navigate them. And synthesizing all of these conflicting signals well, this raises important questions.
It does. With Prologis sitting at this all-time high today, driven by the incredibly sexy, forward-looking narrative of data centers and AI infrastructure, yet weighed down by a 39x PE ratio and exhausted, overbought technical indicators. When the broader market finally blinks and tests that support level, will this 52-week high become the ultimate retail value trap, or are we simply looking at the ground floor of a massive new tech real estate empire? We will leave you to ponder your own move. Until next time, keep digging.